Hi, everyone. My name is Anthony from the PD Group Wealth Management. Next to me is our co-founder, Matt Petey,
Also the brother.
also the brother. Yeah, you're right. I can't believe I left that out. What we're going to talk about today is volatility in the markets, how we are adjusting client portfolios for that volatility, and one of the products that we're really excited about, which is buffered ETFs, and Matt here will explain a little bit further.
Yeah, so obviously with the volatility, we've had a lot of conversations with clients during meetings, how they can protect their assets, but possibly stay invested in the market. You know, younger clients or clients that are looking to take a little bit more risk, CDs and bonds, they don't excite them. Maybe they're a little more exciting than they were 2, 3 years ago with rates the way,
1%.
1%. CD rates right now, five and change, 5.5%. Great, but they really want to see those double digit returns. But they also don't want to be down 10, 15, 20% at the same time. So how can you
Have
have
your
your
cake
cake
and
and
eat
eat
it
it too,
too.
right?
We didn't plan that.
We did not. But yeah, that's exactly what it is. So there's buffered. He's gonna be laughing the entire time now, but there's buffered products out there that we use in our own portfolio and for specific one-on-one clients that are looking for a unique position. But these buffered products work, so they'll offer some downside protection, right? So let's say the October S&P 500 buffered ETF right now is going to protect you 10% on the downside. So what that means is over the next 12 months, if the S&P 500 is down 7, you'll be down 0. If the S&P is down, let's say 15, you'll be down 5%. On the flip side, you'll have one for one on the upside, but then they cap you. So that 10% buffer right now, the upside capture is about 18, 19%. So what that means is if the S&P is up 12, you'll be up 12. If the S&P is up 25, you'll be up that 18, 19% at that upside capture. So um, like I said, great investment to kind of participate in the market, but at the same time, kind of limit and protect your downside risk. So a great investment that we've been using recently.
Now, do they have to hold on to this for a certain amount of time, like you would a CD, where you have to hold it for the extent of the contract?
You don't. That's kind of the nice part about these investments is that it's an ETF, meaning you can buy it at any time and sell it at any time. So if you need to liquidate, or let's say you kind of realize enough upside capture that you're up 6, 7%, and you're like, I want to do something different. You can buy and sell at any time, which is nice.
Now, what if I'm thinking doomsday and I want protection way more than 10%?
Yeah, yeah. Um, we have an election coming up next year. And right now, who knows what's going to happen there? There's markets, with that election, there's uncertainty, there's market uncertainty, recession uncertainty, who name it, it's out there. But they do offer products that are, let's say, deep buffers, and they offer more than that 10% downside protection. So the deep buffer right now, you're liable for that first 5%. It protects you for the next 25%. And then from there on, it's one for one on the downside. So let's say the S&P 500 over the next 12 months is down 7, you'll be down 5. If it's down 27, you'll be down 5. If it's down 37, you'll be down that first 5% and then the additional 7% from 30 on. So, but that's one way to kind of protect yourself a little bit more on the downside if you think the markets are going to be down 20% or whatever over the next 12 months. Um, on the flip side, though, the upside capture is a little lower than the traditional buffer product. The upside captures, I believe, about 13, 14%.
To be
So,
expected.
yeah, so you got to kind of pick and choose what makes sense for you. Kind of getting back to our last video, about getting that second opinion. There's unique products out there. Investment strategies change, markets change. So making sure that your investments match what risk tolerance you have and what your goals are is a good idea.
So is this investment for anyone in particular? Like, is it just for retirees, pre-retirees? Is it just for anyone? What kind of person would want this type of investment?
Yeah. I mean, so we use this product. We're fortunate, being an RIA firm, that we have these products available. These products aren't available to every investment firm out there, uh, and we're fortunate to be able to offer this product. We use this investment in our models, so the models that we manage, we use this as a core piece of it. But it's really for anybody. You could be a retiree that's looking to take a little bit more risk, but still have some downside protection. Or you could be a younger investor that, you want that risk of being invested in the market, but you want that downside protection as well. So, really, it's kind of looking at what makes sense, the deep buffer, the traditional buffer, or maybe a combination of the two.
All right. So how do they buy it? How do they get started?
Yeah.
What's the next step?
Next step, in all honesty, the next step would be to, either meet with your financial advisor. If you don't have a financial advisor, you're more than welcome to give us a call. Get that second opinion. Make sure that you know what your goals are over the next 12, 24 months, maybe even longer, uh, that you're invested properly, see what makes sense, and then kind of go from there.
Sounds like a great plan to me.
Yeah,
I love cake and I love to eat it too.
yeah, who doesn't? So on that note, we appreciate you guys tuning in. If you guys have questions, as always, don't hesitate to reach out to us. Our information will pop up on the bottom of the screen, and we hope to hear from you soon. And you know,
If you have ideas on other podcasts or videos you'd like us to do, drop it in the comments.
there you go. We appreciate it.
We're here for you.
Thanks, everyone.